Going to do a training today on reading DU results. Now we're going to wait just a couple of minutes here to get started so we can go live on all the different platforms. We are streaming live right now on YouTube, Facebook, and LinkedIn. Thank you everybody who was already commenting in the chat, and we put the chat up there so you can drop a comment in as well while we wait to go live on all the different platforms. Hope everyone's having a good week so far. We'll get started here shortly. Great training for tonight. Definitely going over some of the basics of a conventional loan. All right, it looks like we are live on all the different platforms, so we can go ahead and get started. We will take the chat off the screen and then we can get into it. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And every Tuesday and Wednesday night at 7 p.m. Eastern, we do this show going through a loan officer training. Now, tonight's training is going to be based on conventional loans. And although we specialize in non-QM loans here at the Mortgage Calculator, we still do a lot of conventional loans as well as FHA, VA, and USDA. Now, what we're going to talk about tonight is reading DU results. So desktop underwriter, really desktop originator DO, but Fannie Mae automated underwriting system. Excuse me. So Jose actually has results from a DU that he ran that he's going to share with us, pull up and go through and read. So keep in mind, for the newer loan officers out there who might be watching, what got us to this point was getting an application from the borrower, right? And filling all of our fields in Encompass and actually originating the loan in Encompass, getting it ready to run DU. Now, once Jose filled in all the fields, made sure everything was correct, then he ran DU. And at that point, that brought us to these DU results. So I'll go ahead and pass it over to Jose Gonzalez, our sales manager, 27 years of experience as a loan officer and a realtor. He's read many DU before, and he's going to pull up some DU results and go through them here with us. So go ahead, Jose.
All right. Good evening, everybody. Great to be with you here for this great training. Now, this is a conventional loan. In this case, this is a Fannie Mae loan, right? Fannie Mae and Freddie Mac are two conventional type loans. Fannie Mae uses desktop underwriting if you are a broker, and desktop originator if you are a lender. And Freddie Mac uses loan prospector. So in tonight's lesson, we're doing the desktop or DO AUS version. For my Fannie Mae file. Now, I chose Fannie Mae. This is a salaried borrower. He is on W-2 pay stubs. I don't even think he has any overtime. He's definitely not a self-employed borrower. If we were dealing with a self-employed borrower, depending on the specifics, specifically if we're talking about distributions of the income versus their ordinary income reported, those would be the considerations. If you were in my training earlier today, the loan officer training, that is the big distinction that I brought out and I always bring up regarding Fannie Mae and Freddie Mac. It is basically with your self-employed borrowers. So this borrower is not self-employed, and we ended up with the Fannie option. So you'll notice this is submission number 5. It wasn't that I had to run it 5 times before I got my approved eligible. It is because in the market that we are in for this real estate deal, very competitive market, and they do ask for the DU approval to be submitted with the offer. So I gave the borrower the first page to show that he's approved eligible, and it was to the sales price of the property with the exact taxes of the property. So what ended up happening is he did several offers. Every time he was going to do an offer, and if it changed and it was really hot and heavy and they were asking him for that, I had to run another DU. So just keep that in mind. You don't want to be running multiple DUs. Once you get that first run, read the findings, which we're going to do now. Dissect the findings and figure out what is needed to be done to the file in order to get the approved eligible. You'll know where the deficiencies may lie, right? So let's go on with it. Now, we would all love to have a file like this one, right? 49% LTV, given a big down payment. But a little bit of the backstory. This is the second time that I do a loan for this borrower. First time I refinanced his home, and now he is selling his home, has plenty of money to put down on the one that he's buying. Hence, we have a nice 49% LTV, which is good because you see the housing and the debt to income, 46.28 on the DTI. Keep in mind when you are looking at these files, seeing what your findings are, hoping to get that approved eligible. One of the things we also note in our loan officer training is that if you need to get a DTI above 45%, and your LTV is 95%, there's a good probability, very high probability, that you're not going to get it unless the credit score is 700 or above. And on their cash out refis or rate and term refis, that also comes into play when you're maxing out the LTV. If you're not at a 700 or above credit score, you're probably not going to get an approved eligible above 45 or maybe 45 and change, but you're definitely not going to get a 48 or a 49% DTI with a 670 or 680 credit score, most likely, if you're at the maximum LTV for the program, whether it's a cash out, rate and term, or whether it's a purchase. So very important note to consider there. Now, 5.75 was the rate that we ran this at. He is doing some buy down. We did get a good amount of bona fide, so he is able to buy the rate down to 5.75%. 410,000 is a sales price, and the appraised value that we put, even though it ended up appraising for that. He borrower has 16 months of reserves. So that's one of the other factors that automated underwriting is going to look at when they're sizing up the deal. Depending on the LTV, as you're going to see now when we get into the assets, sometimes they don't ask you for reserves, but this is just sizing up the deal there. In some cases, that is what makes or breaks your approved eligible is reserves. So now we get into property information. It is a condo, 1 unit, primary residence in Miami, Florida. So here we go. Risk eligibility. Now this is a good sign here. Value acceptance eligible. You'll see when we get a little bit further down in the report, once we talk about the appraisal, you'll see a nice little present we got there. So here, obviously, it's approved eligible, so this is all going to be good. So risk profile appears to meet Fannie Mae guidelines. Obviously, underwriter's going to give it the final check off on it, make sure all the I's are dotted and the T's are crossed.
Jose, real quick.
Yes.
On the risk eligibility. So here, you're approved eligible, you're walking on water here, you're all to the good. What are the type of things we're going to see there when we're getting,
Well, if it doesn't meet it, it's going to tell you this case does not meet because you received a refer ineligible or refer eligible, whatever it may be in the case. It's going to tell you this case file does not meet Fannie Mae guidelines because you receive a refer eligible, and it'll give you a couple extra little words there, but it won't really tell you much in this section here. It's just going to tell you what you already know. But where it does tell you some of the scenarios, it would be right here. In my case, this deal's case, the following risk factors represent strengths, right? But that would be if it was not an approved eligible, the following risk factors represent the weaknesses in the borrower's loan application. And it could be the combined loan to value. It could be the excessive delinquencies. It'll give you a little message here for you to look for, and then you just have to go through all of the different sections and the findings. But this is where it tries to highlight what is the strength. So in my customer's case, credit profile was good, combined loan to value ratio nice and low, also nice strength there. So now we go on here. Let me put the screen up a little more. Okay. So this is just some legalese here, but now here's some of the stuff we got to look at here. Must close on or before 9/8/2023. That's due to the age of the credit report, right? This credit report, I believe, was run on 5/8 probably, and its credit report usually is good for 120 months. Now that says must close on or before. Now, when it's at the investor, they're reviewing the documents. They may ask us to, not just do a refresh, but maybe ask us for a new credit report, because they certainly don't want it to expire before it closes, and they got to sell the loan and all that good stuff. So, rule of thumb is if your credit report at the time you're going to submit the loan is going to be 60 days or older, you would need to get a new credit report to submit to for underwriting review. See, so right here, all credit documents must be no more than 4 months old on the note date. For guidelines on the age of the appraiser property inspection, they're referring us to the Fannie Mae selling guide. So we don't have a home equity line of credit on the property, but they're letting us know that the maximum CLTV, if we were doing this as a combo loan with a HELOC, we could go up to 97% on the purchase. So those of you out there looking at those combo loan opportunities, note that this is where you can find out the maximum that you could do for your particular loan. But they're still telling you to verify terms for compliance with the selling guide. So now, some of the things I did in the application was I put a couple of accounts that were going to be, one account that was going to be paid off. Right, had a balance of 30,120. So it's telling me include the evidence of the payoff. Now, in my case, my borrower already went and paid it off before the closing. So what I'm going to do instead is I'm going to ask for a credit supplement, and the credit supplement will verify the new balance as zero and that it's closed. And that will be all the documentation that underwriting will require, rather than getting messy and waiting till the end and providing a payoff and all that kind of stuff. He got the money already, he paid it off, and I'll do a credit supplement, and that'll take care of that condition there. So now we have some omitted accounts that the system omitted, and it is the loan on his current residence that is being paid off with the closing of his home. So that's going to be paid off way before he closes on the purchase that he's doing right now. So I marked it as pending sale in the application. When that happens, automated underwriting knows to not include the liability, the monthly liability, in the DTI, but then it's going to ask for documentation to support the omission. So you'll see, I think there's going to be conditions a little bit down, but that's going to be the closing statement from the purchase, or excuse me, from the sale, the closing statement from the sale, and then the transaction history from the checking account showing the funds going in. Plus, that's for the assets part. Plus, I'm going to do a credit supplement showing that this account is now paid off with a zero balance. And at the same time, I'm going to use that supplement to update the payment history, because you know that when you close, you have to have the payment history updated through the current month. The credit report was probably only reporting through May, since it's a May 8th report. So I have to bring the credit report current to reflect the June payment as well, which is going to be a condition. So the credit supplement is going to take care of those two items. Showing
what loans is that required on, Jose? What kind of loans?
Excuse me?
What kind of loans would a supplement be required on?
On every loan that I know of, if you're
every loan that's ever been done in the history of loans, guys. So yeah, what Jose's talking about is not just conventional either. This is every loan ever. So just pay attention there. Yeah. It's a good little nugget.
On every loan, you need to. Now, this is a lot easier than having to provide payment histories and all that kind of stuff. You can get a supplement to update the payment history. Bring it current. And in this case, show that it's a zero balance already paid off. So now here is the interesting part as well of the file, is when we're talking about the income documentation, right? We can never assume that tax returns are going to be needed. It is awesome when tax returns are not needed, because that means that I'm not going to have to provide a tax transcript, a record of account tax transcript. Those can cause a delay if the tax returns were just filed, and may take a week, 2 weeks, 3 weeks. If we're in the middle of the tax season, it could take a month for the IRS system to update and be able to provide the record of account, in which case we'd have to try to find a workaround. But in this case, excuse me.
Can I say something there, Jose? I want to make sure everybody's careful there. Remember, just because Jose said we can get a W-2 only file, remember, guys, just because it says that, there's another rule that's not written here in this DU, that if there's any rental property income, any self-employed income, any of those things, even if you're not using it, you didn't put it on the app, tax returns are required. It's not optional. So make sure you don't read too much into exactly what it says there, because if Jose had just accidentally forgot that he has a side business and accidentally not disclosed that, that would be a tax return required file, even if we don't use the income from that side business.
Yeah, and then you may have a potential issue if you're bringing up a tax return, because then they're gonna be looking at the write-offs that they may be taking in their profit and in their Schedule C or whatever it is that they're doing, and then they're gonna look at the net income. So, and that could affect the whole scenario, because when they do the fraud guard, sometimes things come up like, hey, there's an LLC that this borrower has. Show me the information on that LLC. And then it could open up a whole can of worms. In this case, my borrower doesn't have any type of self-employment and is not reporting any rental property income. Because if there is rental property income, just providing the lease is not going to suffice. You're going to have to provide the tax returns, because they're going to want to look at how much rent they're actually claiming in gross rent. And then they're going to want to see all of the expenses that they're claiming. And a lot of times property owners get very creative on their investment properties and the write-offs that they take. Depreciation can be added back, but that's about it. So again, here in this one, though, all they're asking for is a pay stub and a W-2 or a standard written verification of employment. Now, when they're talking about a pay stub, it means, you'd have to refer to the Fannie Mae selling guide, which they ask for 30 days worth of pay stubs. So 30 days worth of pay stubs and a W-2 from the prior year, or you can use the standard written verification of employment form in lieu. Notice the pay stub must be dated no earlier than 30 days prior to the initial loan application date, and it needs to include year-to-date earnings, and it has to have all the complete information. Make sure you review those pay stubs very well, though, because pay stubs can also disclose some negative information, like undisclosed loans, undisclosed child support.
What does the
Right?
undisclosed loan show up as? Okay, Jose, like a 401k loan, it'll
Well,
say.
if it's a 401k loan, or it could be other kinds of loans that they're just getting auto debited from their earnings, and it may not be showing on the credit report, and they may have forgotten to tell you about it.
Yeah.
Make sure that you review those pay stubs well, and you ask them, hey, what's this deduction? What's that deduction? I see this here. Now, on the 401k is not necessarily a deal killer if they have a 401k loan, as long as they show, you look at the Fannie Mae selling guide, as long as there's enough assets still in the 401k to cover the amount of the loan, you're good. Plus, I believe the guide says if it's a secured loan from the 401k, I think that should be good. They're not going to hit you for it. But again, refer to the selling guide, confirm that. The whole point of this part of the exercise is look at the pay stub very well. Don't just look at the earnings, net income. Okay, that's fine. No, look at everything that's in there, because in the past, I can tell you, underwriters, they bring out the magnifying glass. They're looking at every single transaction in that pay stub. Another recommendation is, if you have a nurse, get a written VOE. Nurses have crazy pay stubs. Differential for night, differential for weekend, differential for the differential, the this, the that, the reimbursement for the training. It's all over the place. So it's really hard to get their HR to write a letter of explanation explaining what everything is. So it's usually best to get that written VOE, and they're gonna put it where they gotta put it. It's either gonna be
There's only 3
base,
categories they
right,
get, right? They're just
base pay, commission, or overtime. Excuse me, base pay, overtime, and other. Hopefully, they don't put it in that other category, because then that's where you may run into some issues if the other category is not the same every year. Because remember, there's an average for 2 years on those. So my borrower is easy, really easy. Nothing weird in his pay stub. Matter of fact, he only gets paid once a month. So it's just one pay stub. So real easy. So notice here, just a little pointers. They tell you if you used a written VOE, it must include year-to-date earnings as well as prior year earnings if a W-2 is not being provided. And the written VOE is usually the way to go if you have a lot of overtime also, right, and bonus income. You're going to have to get that written VOE, and you're going to have to make sure, if it's going to continue, that they write in there that it's going to continue, and that maybe they throw in something else. I think it's box number 20 in the remarks. Try to have them be as detailed as possible on that. And now here they're asking for either verbal, written, or who are not self-employed no more than 10 business days. So it could be a written, verbal, or email verification of employment at least 10 business days prior to the note date.
they updated that recently at the new thing. That's a new way to write it. It used to just say verbal.
Yeah.
But Jose, let me drill you again. Just a redundant question here. What files besides this file will require a verbal VOE?
Verbal VOE would be any full doc file.
Any file with income
Yeah.
from an employer, basically,
Yeah.
right?
Mm-hmm.
So this isn't just conventional, guys. This is every conventional. This is every FHA. This is every USDA. This is every Freddie Mac. And this is every non-QM file that includes income. So That's a great little tip there. At least they have a couple options now, but it used to be just verbal.
If they're self-employed, you still have to do the verification, but it's different. The verification for the self-employed borrower is to show that they're still that the business is still active. So usually you're going to be looking at showing recent contracts, bank deposits into the business account, business activity, uh, plus maybe a processor cert or a letter of explanation, maybe a little letter from the accountant, the Sunbiz showing that they're still active. A couple of things that you're going to have to combine for the self-employed borrowers, depending what type of business they have and what type of documentation they can provide. It's not going to be a verbal where you're going to be calling them, or the process is going to be calling them for them to tell you, oh yeah, I'm still in business. No, they're going to actually have to provide proof. So notice they put here direct verification by a third-party employment verification, like the work number. And notice how they have a specific category here, specific entry for military. Military is a little bit different. Notice they even provide the URL there for where you can go and obtain the military verifications. All right. So now they want my borrower to provide an IRS Form 4506C, as in Charlie. Now there is a new form, I think
That's
2021 or 2022, newest version of 4506C. And we do have guidance for our team. We do have guidance in our Knowledge Center where you have copies of that form, as well as copies of the verbal verification of employment form that you all can use to complete the verbal verification of employment.
I'm going to ask you another stupid question, Jose, before you move on.
Sure.
What files require a completed and signed 4506C?
Any file that has income.
Exactly. So this isn't just DU, guys. This is any and all files with income. Now, there's a difference between completed and signed and the actual result, right? Some underwriters require the result. That's where then they need to verify something when we don't have like a signed tax return in the file, and they need to actually verify it, right? So every file requires what you see there. Some files will require it to not only be completed and signed, but the results returned and retrieved, right? Verified. So a couple different kind of ins and outs there when it comes to that. And as Jose said, newest version of the form, they've changed it 3 times since it got released.
Now, here's a nice little bullet point that touches base on this. Now, sometimes we can be lucky that DU can actually validate the income internally, right? That happens, every now and then, that it's a big enough company and they're reporting through wherever they got to report it. If DU can validate it internally, then it says a completed and signed Form 4506C is not required. But in my case, it was not able, even though this borrower works for a university and everything, they must not be reporting their data. So the 4506C signed has to be turned in. We don't have to execute it. We don't have to go to request transcripts. So now here we are in the assets section. So this is all based on the application, the cash to close, plus the accounts that were being paid off. Now this is going to change because when I go to final, now that the file's almost done with the document procurement and the processing and all that, he closed on his purchase, he deposited the money, he paid off those accounts. I'm going to do the credit supplements. And then once the dust settles, I'm going to rerun automated underwriting. And I'm not going to final it yet until I know I'm going to be clear to close, but I'm going to rerun it. And then that's going to be provided. And then that's going to have different assets that are need to be verified. But this here includes the account he was paying off, plus the cash to close, no reserves.
Make sure we run over what you mean between prelim, interim, and final when we get down to like the 23 section where it starts to pop up. Okay.
Okay.
Because I think you glanced over that too quick for everybody. Let's run over it one more time.
Now, notice here number 15, since I did put that he had a pending sale when we did the DU, he hadn't closed yet on the home. So it says all net equity funds should be verified with a photocopy of the settlement statement, which he has already provided to me. And is not negative. He actually had, proceeds. If depository assets, here, let me put this up a little. If depository assets are needed to support the amount of funds in reserves, they're asking me for a 2-month period. So I need to provide 2 months worth of bank statements. And if I do a VOD, direct verification provided by third party asset verification are acceptable if completed in accordance with the selling guide. They always refer you to the selling guide to make sure the correct form that you're using.
Our vendor there, guys, too, we have the vendor, our Fannie Mae Day One Certainty vendor is account check. So we can do the VOI, the VOE, and the VOA that Jose just went over. So that's our third party partner that we can use to supplement this report and actually get it cleared with a Day One Certainty
Awesome.
vendor.
So there it's talking about our earnest money that was listed on the contract. I think you had $5,000. We put that on the application. And they're saying that is if the deposit is used to make any part of the borrower's minimum contribution that must come from their own funds, the source for the deposit must be verified. So the $5,000, we'd have to verify that it came from his account. That would be the account copy of the check that he's already provided, the account transaction history to show the $5,000 leaving his account.
Jose, yes. Let me ask you that one more often. That's one of the things that catches people off guard there, and they have to back out a EMD deposit. So pay attention to that, guys. It looks like the easiest one on the whole list, but it's actually not necessarily, because you need to actually verify it and source it, right?
Yep, absolutely. And what happens a lot of times, I'm going to tell you, the application gets completed, a deposit gets put on there, account balances are put on the application, but the balances are from the month before the deposit was actually given. So the application really is not accurate, because if you're putting that deposit and you're putting the account balance where you haven't deducted the 5,000 out of there, then you got to do some reconciliation.
You can't double count it.
Yeah, exactly. So in my case here, he has a gift that he was getting. So actually had 2 gifts. So they want a signed gift letter. And here's something that I want to explain so that you don't confuse the conventional loan gift requirements with the FHA gift requirement. Notice second bullet point there says documenting the transfer of the funds. All that means, that does not mean that you have to show the transaction history of the donor. That you have to do for an FHA loan. That just means you have to show the transfer, like there's a check that was given. So they're going to ask you for the canceled check, or maybe it was given in the form of a wire transfer. They're going to ask you for a copy of the wire transfer, as long as you can show clearly that money came from the donor. So if hopefully the wire transfer document identifies the donor's name somewhere on there, right? Or if not, maybe the transaction history from that the borrower in the borrower's account will show wire transfer from John Doe, right? Okay, we see John Doe gave him. That's fine. You just verified that who the money came from, right? So if you cannot show somehow or another something with the name of the donor as the transfer document, they're going to ask you for proof of the money leaving the donor's account to be able to substantiate that they actually gave the money. So I've actually had that happen. We had a wire transfer in the incoming account. It doesn't show the money, the name of the person who gave it. And then, they had to get creative and they had to dig deep and find me the transfer document. And then ensuring the gift comes from an eligible source and does not come from an interested party to the transaction. So, they're usually looking at blood relatives, but they will accept a close personal friend. You just have to document the relationship. It has to be really close. I mean, I had one recently where they had to have the letter from the donor about I've known him 28 years, yada yada yada. We were going on vacations together, lifelong friend, and another letter of explanation from the borrower about how close they were as friends, in order to make it plausible that somebody would be just giving you for free $5,000 or $10,000. So that be aware of that. It is possible with somebody other than a blood relative, but you got to really document the file. And notice if it's not a gift, if it's obligated to repay, but if it is for whatever reason, then you got to document the liability. Okay, now this is really important so you don't get caught off guard. Point number 19. Notice how every number is important here. Don't just look at the approved eligible at the top, get all happy and run with it, and then get hit with conditions from underwriting and say, where did that come from? Why are they asking me to document these deposits? I have $300,000. Isn't that enough for them? And that's okay, but it says here, when depository assets are used to support the amount of funds required in reserves, document that any deposit that exceeds $3,145.84. Notice they're giving me the exact dollar amount.
The exact. If it's 1 penny more, guys, it has to be verified.
And how did they arrive at that figure? Because it's 50% of the total income provided on the loan application. That's how they arrive at that figure. So they got, DU gets the monthly income, divides by 2, and that's the number. So they'll let you slide on 500, 700, 900, but if it's 31.45 and 85 cents, you're 1 penny over. Document that deposit. That's similar in your, this is a little off topic, but in your bank statement loans, a lot of times that's what it's going to boil down to. When you're doing bank statement for income, they're usually gonna obviously refer to the guidelines because they're all different there, but they're gonna refer to 50% of the monthly income as well. So in this case, this is that. And I had like a 10, 15-minute conference call with this borrower and with his father, that is his donor. His father is a CPA, so you know how those CPAs can be, right? He had a problem with, why do I have to sign a gift letter? Why do I have to give him a gift letter? So I'm telling him, because we have to document the large deposit. So I had to reach out and read the condition to him and tell him, listen, sir, okay, let me go here, see what it says on the gift, and then also see what it says. So even if it wasn't a gift, if we say it's just a deposit, fine, but then I got to document the large deposit. So what do you want me to do? Document the gift or document the large deposit? We're gonna go back to you.
It's the same difference either way.
Right. You're the source. So finally, I beat him down. He's like, okay, whatever, just send me that form, I'll sign it. But I don't know what his fear was.
That's a good technique, though, guys, for the newbies out here. Remember, it's not us asking, right? We're with the borrower. We're like, yeah, I don't want to ask you for anything we don't need. It's not the law, right? It's not like we're citing the law, but you're citing the guidelines. It's clear as day. It's public, right? You could share this snippet with your borrower, or you could share the full guideline, which is like 10 pages long, that tells them exactly how gifts have to be documented. And they'll be like, oh, okay, I don't want to read that, fine, sorry. Right? Real easy to send somebody a third party and say, look, this is the government basically telling you to do this, not me. I don't care, right? It's not us.
So now number 20, here's where it gets interesting, because this property is a condominium. Now, in Florida, those of you that may not be, deal too much with the Florida market, condos usually have an issue of inadequate reserves. People just don't want to pay the higher maintenance fees. Most of the homeowners don't want to have a reserve account because they want to keep the money, the expenses down. I mean, it's penny wise and dollar foolish, if you ask me, but nevertheless, in this case here is what's very interesting, because it's telling me a limited review can, and I'll explain what a limited review is in a minute, but a limited review can be performed if the property is in an established project and the property is not ineligible as defined in the selling guide. Now, a limited review also has to follow. Let me see, do they put another bullet point there? Well, probably down there, but it has to follow the Fannie Mae guidelines of when a limited review can be done. Now, in every other state other than Florida, at a 90% LTV or lower, you can do it as a limited review. Florida, it's 75% or lower for primary and second home, and 70% or lower for investment property, right? So that's a good point to consider, because what that does is then it allows you to use the short form, which does not ask questions about the budget, does not ask questions about delinquencies in the collection of the monthly assessment. It also does not ask questions on the number of renters to owner occupants, because those are real big stumbling blocks in some communities that may have a high proportionate amount of renters to owners, or not collecting the 10% of the annual budget reserve, which many of them are not, or that may have, I think the number is 15%, I believe, 15% or greater of the accounts could be delinquent. And then you wouldn't be able to get the financing. So in this case, my LTV was 40 whatever percent, so I can definitely do it. So let's see what the other points here says regarding that. So if the property is not in an established condominium project, ensure, okay, so we'd have to read the guide to see what they mean by that. If it's a detached condo, real interesting one here now. If it's there are such things as single, detached, single family type looking condos. So if it's a detached condo or a project consisting of only 2 to 4 units, a project review is not required. That means you don't need the condo questionnaire. Totally. Real good situation there. And then notice how they tell us about if the property is located in a state in which specific project review guidelines apply, and confirm the loan case file. So they're telling me go to the guidelines and see if you're in Florida or not. All right. So now here we're talking a little bit more about the address, right? So standardized address, so no problem. Let's see.
Let me touch on that 1 second, guys.
Sure.
If you don't get a standardized address, you can't get what Jose is about to say for the next one, which is the golden ticket, right? The waiver. You also can't get really a valid DU, right? DU is not going to be valid until it returns a result, right? If DU can't return a result on that parcel, aka your address isn't right, you're technically not, you don't have a full DU. It might say approve eligible at the top, but you're going to get a bunch of little errors here that you're going to have to resolve by the end of the loan, right? So make sure just because you have approve eligible doesn't mean that you've cleared all these conditions. So remember, if it says here you didn't get a result on standardized address, you can't do the loan until you get a result on the standardized address. so just because it said, yeah, sure, if this house does exist, you can do it, but until it gets a result that shows this house exists, it won't actually work, right?
That's why it's so important to make sure that you have the address correct. Don't just go by the address that the realtor put on the contract, please. So we got our standardized address. The second bullet point is just playing off a little bit of that. So it's telling you if you don't get it, you're gonna need a full interior and exterior appraisal. It's telling me now, this is very important. Bullet point number 3 is letting me know that the appraisal, if I'm going to use an appraisal, must be on form 1073. That's a specific form number for a condo. But now, point number 22 tells me DU accepts the value submitted by the lender for this subject property. That's an appraisal waiver. To exercise the value acceptance, Notice it has in parentheses appraisal waiver offer with representation and warranty relief on the value, condition, and marketability of the subject property. The loan delivery file must include the case file ID and special feature code 801. So right there, that's what it's letting us know, which is great because let me tell you, that's how you get these deals, because there were like, 6 or 7 offers for this property. And, this one here is like, hey, don't worry about the appraisal. We're good for it. So that's what gets you the deal. That and they went above list price. I think they went like $21,000 above list price. But we got the appraisal waiver. So let's keep going now to our observations here.
So run this over one time, Jose. This is where we need to talk about. This is prelim, so you still haven't done interim yet. So
right.
This is prelim. So explain prelim, interim, and final, please.
So notice there, number 23, where it says the loan case file was submitted to by us to preliminary findings. So, because remember, that's at the onset of the case. That's the initial application represented to you. We have to vet the information, right? We got to vet everything. We got to gather up our documents. We got to do all these things that we need to do. Like I was mentioning a few numbers up there, so that then I can update my application and then run the AUS as an interim report, which is going to now be associated with an investor, right? Who is going to be the end investor on this file, right? And then in the end, when the file is clear to close and they're telling you, okay, please finalize the DU to the investor. Once you finalize that report, you don't have access to it anymore. The investor does.
Don't final it until you're ready, guys.
Yeah.
AKA, right?
Yeah. You final it too quick, pull the trigger. You're going to have to tell the investor, hey, investor, can you release that DU back to us, please, so that we can work on it? Because we got to make some changes. So
a change could be as small as 1 penny on insurance, right? 1 penny on insurance, and now you're delayed 2 days to try to get a DU released and back to you, and then fixed, and then sent back, and then sent back to the underwriting, and then cleared again. Oh my goodness!
Nightmares.
Please don't let 1 penny take 2 days, 3 days.
All right, so I think we are good here. So let's keep going down. Special code, our only special code. We got a DU. Now it's telling us here, refer to the special feature codes list on FannieMae.com for a comprehensive list of what that actually means, if there's anything weird here. So DU loan, value acceptance waiver, we're good to go there. And here it's telling me the credit report associated with the file, my borrower name, credit report ID. I mean, shouldn't be somebody else, right? And the report date. That's why it said September 8th, because that would be 120 days. Now, here's a little message here. If I was doing, this is more for the home possible or home ready type loans where you're talking about Fannie Mae and the AMI and all that kind of stuff. And the census tract is more where you got to pay attention to these messages to see what is possible. You're going to go to the census tract where the property is. It's going to tell you what 80% is or what 100% is, depending on what program you're doing. Maybe you got to be under 80%, or maybe you got to be under 100%. So,
but remember, if you don't put the address in, the standardized address, you can't do any of those AMI-based loans because you won't have a valid census tract result. So make sure, again, everything has to be perfect. It might throw out an approve, but if you're going for that special code and it doesn't have that special map to AMI and it doesn't convert that, you don't technically have an approval.
And here's letting me know the area median income also known as AMI for this area, is 77,900. So then they're telling us some more information here on number 28 for some of those other types of programs where they're trying to promote additional home ownership. You can look at that and see if it pertains to your case. Letting you know, a minority census tract is a census tract that has a minority population of at least 30% and a median income of less than 100% of AMI. And the reason it's telling me that, my deal could qualify is because, as you all know, in South Florida, we're about I would say that census tract is probably about 90% minority, which would be everybody other than Anglo-Americans. So, you got all the Hispanics from all over the place. You got Black Americans, you got a lot. So that's the beautiful thing about doing business down here, is that we got a lot of diversity. Following credit scores, let me know what we got right there. Obviously, it's a beautiful thing when you got a 764 middle score, right? No pain there. And this is just a rehash letting me know my base employment income, 6291.67. And here, our gift of cash, net equity from the sale of the house. And this is what he had in the checking account when the application was submitted. The account that we marked that was going to be paid off. Letting me know what I got to do to exercise the appraisal waiver. And then over here, again, the underwriting analysis. This is where it's good that you have to look at this and compare this page, especially to your application in your LOS. In our case, we use Encompass, to see if it's the same. Look at the principal and interest that doesn't change, the interest rate, DTI, LTV, all of this stuff right here. So it has to match exact. Shouldn't be any reason. Now, what happens sometimes is that DU, is smart, right? And it's gonna say, wait a minute, that's an installment account. There's less than 10 payments left on that installment account. You don't get accounted. So DU will do the work for you that you forgot to click on when you're supposed to exclude liabilities because there's less than X number of payments, and you're supposed to go into the application and input that information there so that the DTI is correctly reflected in Encompass. That could be a reason why you could have a DTI difference in your installment accounts. So here now it's including less than or equal to 10 months, 46.28. I don't think he had any of those in his account. And then my proposed monthly payment. Now, this on my interim is going to change because I just received today the binder for the interior insurance, and it came out a little bit higher. I quoted $1,800. I estimated $1,800. It came out to $2,100 and change. And also, we have a flood cert that showed that a portion of the property is in a flood zone, so they need flood insurance as well. So that's going to be an additional payment, but we'll be okay in our DTI. No MI, of course, a nice low payment. And my total expense payments, that's another thing where you got to see, reconcile and make sure my all other payments is $801, so you can make sure that it adds up. You don't have any discrepancies. HOA fee, you can see why this is $610 and they don't have reserves. $610 a month. That's a lot of cheese. And that's it. And here is now where it's telling me my funds required. And look here now, total funds to be verified is the same amount there. And because it's not because of my low LTV and my high credit score, it's saying I don't have to verify any money above this, which is fine, even though my borrower has 16 months worth of reserves, even though it says excess available assets not required to be verified by DU, 35,663.79. but it's not needed. So this is where you would go to figure out what's the issue with my file. Why am I not getting the approved eligible sometimes, or why am I getting an approved ineligible? Usually will be because you don't have enough assets, or maybe not have enough, reserves. So preliminary recommendation for this case is approve eligible. So now that I got my insurance today, was my final missing link. I'm going to get the flood insurance through Neptune so that I don't have to get an elevation certificate, because this is a condo. They're not ordering a survey. So the borrower would have to pay like $250 to order an elevation certificate. And that would be a delay of 3 or 4 or 5 days. So we go to Neptune, and I'm pretty sure that it's going to be $400 or $500 for the insurance, and they're going to bind it like right away, immediate, as soon as you pay, of course.
And we can put our
mortgagee
clause in there.
Everything, it's beautiful.
Yeah, one thing I want to touch on here, the reserves, guys. That last number, one of the most important numbers there, month's reserves. As Jose said, sometimes it needs confirmed, obviously, right? If you get an approved ineligible, many times you'll be short on reserves, and it'll tell you right there. But even when, in Jose's case, that's one of the reasons he got a waiver, because those are, contributing factors that are going to mitigate the risk, how many reserves. So even though it wasn't used to be verified, that number of 16 months is what triggered the PIW and all the other great stuff that was on this approval. So remember, guys, make sure your reserves show up correctly. That's going to obviously be your, contributing factor to trigger a lot of the other positive results on the whole file.
And that is it. So let me unshare my screen.
That was great. I think we have a couple of questions. We went a little over an hour, so we'll wrap it up shortly. But let's see here. Got some questions.
Jose almost hit this question while you were talking about it, Jose. Elevation cert and floor of the condo. Really kind of dumb rule there, huh?
Yeah, I'm going to tell you what. It doesn't matter.
Yep.
They're going to, because I'm trying to figure out why. Because I've had them where what happens is, unfortunately, in these cases, now I haven't received the condo master policy yet, nor the condo questionnaire yet. That should be coming in the next day or two. But when we get it and we turn it in, that's gonna say a certain amount of coverage, and they're gonna look at how many units are being covered, and they're usually gonna come back and tell you the coverage is not adequate, and your borrower has to get flood insurance, right? I had it happen on a condo that was on like the 15th floor. I'm thinking, okay, but what's gonna happen? I mean, but flooding can happen from a lot of different ways. Flooding can happen where, the sewage system of the building may not be able to properly drain, and then all of the toilets and everything, all of the water could back up into all the units. They would tell you, hey, wait a minute, that's a flood. That's not, so I mean, it could be a lot of things. But the underwriters require it, and they're not going to close the loan if they're requiring it to have flood. So yeah, you can't say, wait, it's on the 15th floor. They could say, oh, the whole bottom of the building could flood and could stay flooded for months. Okay, what do I do then? I don't know how flood insurance is going to help me, but yeah, it's one of those things that you scratch your head and say, why do I need it? You just better hope that it's not expensive. And then again, how do you do an elevation certificate for the unit on the 15th floor?
Yeah, and why?
Right. So use Neptune, and you don't need an elevation certificate. But if you go through the standard national flood insurance plan, you're gonna be required an elevation certificate. They're gonna have to do the flood application, and unless you have a really good agent that's willing to work with you, the borrower's gonna have to pay for the flood policy, and you're gonna have to wait for the flood policy to be issued before they provide the deck page to you. So,
great question.
I say Paul's question, I believe, is when we were talking about if a tax return
is required.
Is required for self-employed income.
Guess what the
rental.
answer is always? Read the guidelines, right? Yeah. That's Jose's go-to answer, right? I can't tell you the answer. The guidelines will tell the answer. They change often. But I will tell you that if there is rental income on there, it 100% says tax returns are not optional.
So. What they're going to do now, what Paul is referring to there is an unseasoned rental, right? Mm-hmm. So if it's an unseasoned rental, in other words, you bought it in January, February, March, right? Whatever. You haven't filed a tax return yet because, 2020, if you would have bought it in November of 2021, it would have had to have been on your 2022 tax return. And if it wasn't on the 2022 tax return, they're not going to let you include the income at all. It's like, sorry, you can't use it because you didn't claim it. If you would have bought it after, on January 5th, 2022, it doesn't have to be on the tax return, or I don't know what year, but you know what I mean, right? On the one that would have been this year. But if you bought it now in January of this year, 2023, it would not have to be on the 2022 tax return. And then you would go with 75% of the income. You'd have to provide the lease. And depending what month you're in, if it's already now in July, you'd have to show at least 3 months of the income received. That's usually what I see the underwriter asking for, proof of receipt of that full amount for the last 3 months. And then they're going to chop it to 75%, but you also have to have the lease. So if your landlord is collecting cash and not depositing it in the bank, then they're going to be out of gas. They're not going to let them use the income at all.
All right. Great questions. Great topic. Great training. When I sent out the promo for this, I said, very important. This is a good one. And we're actually going to continue this somewhat tomorrow. So Wednesday, 7 p.m. Eastern time. It's going to be kind of a part 2 to this, going deeper into structuring, Fannie Mae conventional loans. So thank you, everybody, for tuning in. Thank you for the great questions. Thank you, Nick. Thank you, Jose, for the breakdown. And we hope to see you all tomorrow at 7 p.m. Eastern time for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Take care, everyone.
Thank you, everyone.